सर एक बार वो चेक कर लो लाइव पे।
या लाइव आ गया।
आपने कर लिया चेक?
या आ गया, नोटिफिकेशन आ गया।
ठीक है, सौरभ होस्ट बनाऊंगा बस देखो।
Yes. And let the flare be on the screen.
Saurav, where are you?
Saurav, get in.
Make me the host, so I'll put the flyer on the
I made you the host.
Okay, cool.
Make it full screen.
Yeah, sir.
If others can keep these videos on, it will be really great.
Okay, we have Mr. Bhargav with us. I'm admitting, sir.
Okay.
Okay. Good evening, sir.
Good evening, Bhargav ji.
Wait,
please unmute him.
Yeah.
Hi, good evening, guys.
Good evening, Bhargav ji. Can you hear us, Mr. Bhargav?
Yeah, I can hear you guys. I'm loud and audible, right?
Yeah. So we're starting in a couple of minutes. There are more people joining in. A couple of minutes joining in. We're already live on YouTube.
Okay, perfect.
Please unmute Shweta ma'am. Devik, Saurav, please unmute there. Shweta ma'am and Poonam ma'am.
Yeah. Yeah, Poonam ma'am is on unmute and Shweta ma'am, you are unmute too.
Others, just put a reminder in your class groups for all your friends that we are going to start in a couple of minutes.
Hi, Bhargav. Most welcome.
Hi, Sarah. Good afternoon.
Sort of just keep checking the waiting room. I think so the people waiting to join in.
Yeah, I've allowed them to join.
Yeah. Sort of in the meanwhile, you can also share the link on YouTube. Share of link of YouTube to Shweta ma'am and to me also. You can share it.
Yeah.
Really great. So you can put it across on the teachers group also.
Okay, sir. Yeah, so I've shared it on the group.
Okay, fair enough. Thank you.
Yeah.
Shweta, it's 4 now. I think
Yes.
we should start then on time. So
Yes,
that we have
we should
already
start. Yes,
we already have a guest
surely.
also. So
Yeah.
as 4 o'clock, so we should start now. I think.
Yes.
Poonam ma'am,
Yes,
are you there?
yes.
Okay. So Saurabh, you can
Yes, sir.
initiate and start.
Yes, sir. Good evening, everyone. I'm Saurav Moti Ramani, a SY BFM student. I would like to welcome you all to today's alumni lecture series. Today we have a special guest with us, Mr. Bhargav Selarka, and he'll be talking about basics of derivatives and various derivative strategies. Now I would like to call upon Professor Rahul Mishra to give a welcome address. Over to you, sir.
Thank you, Saurabh. Thank you, Saurabh. At the outset, first let me welcome Bhargavji for this interactive session here, which all the students are awaiting, especially the market students and the BMS students, and across all students are waiting since they have heard that your derivative session coming across. So they were waiting keenly that what you're going to learn. So I said to them, wait for some time. We'll come to know what exactly you're going to learn from it. So first of all, welcome on behalf of HSNC University and HR College Commerce Economics. We welcome you for this session.
Thank you.
HR College has been, as you are always the alumni of our college, we are proud to have you here. And as you are aware, we always have looked for student enrichment through various lecture series, whether it's corporate, whether it's industry leaders or stalwarts coming us and interacting with students to give them broad vision and enhance their learning experience. So let you tell you, Bhargav, we have also started a few more things. Apart from the alumni series, we also started the parent lecture series, where parents are also coming ahead and interacting with students. Apart from that, we have the corporate lecture series also going on. Okay, and to also tell you, Bhargav, we have also now we also got an opportunity to become a university now. So HR College, KC College, and Bombay Teachers Training College now called HSNC University. So now this gives a broad scope for us further to also have more such activities aligned up and look for the better development of the students. So once again, on behalf of HR College and HSN University, I welcome you to this session. And now, Saurav, can we have something for as a remembrance and nostalgia feeling for Bhargavji?
So, so Saurav is on mute actually.
Acha. Saurav, are you there? He's on the host, right?
Yes, Saurabh?
Shweta is the host, I guess.
Oh, okay. Okay. Fine. Okay. Okay. There is a power cut at Saurav's place. So, Devik, would you like to just start with the video?
I don't have the video. I just a second.
Okay, Saurav is joining. I guess he will
Okay.
be able to do it.
Saurav has joined. Yeah.
Saurav, you're there?
Yeah.
Yeah. Please unmute him.
Shweta, make Saurav the host.
Yes.
You're the host, ma'am, right now. Make Saurav the host.
Yes. Just a minute.
Saurav, the host now. You can unmute yourself. Saurav, you're the host now. Saurav, are you there? I think so. Again left.
So, Devik, are we starting with the video? Do we have the video?
Please unmute him. Poonamjan, you're the host.
Yeah. I'll unmute Devik.
Yeah. Saurav also joined. Saurav, can you hear us? Please unmute him. Please unmute Saurav.
Yeah, I'll make him the host as well.
Yeah.
Sorry for that.
No worries. That's technical thing. That's part and parcel of today's activities. So it is bound to happen.
Yeah.
Yeah, please unmute Devik also, Saurav. Have you made the host to him?
Yes, I've made Saurav the host.
Saurav, you're the host now. Please unmute Devik also, and please unmute yourself also.
Yeah, sir.
Yes, so Saurav, can we have that's happened. That happened, Saurav. No worries.
Yeah.
Can we have the glimpse of the activities what HR got known for, and let's have the video of
sir,
HR
definitely.
College.
Here we have the video.
Cause you're a sky full of stars. I'm gonna give you my heart. Cause you're a sky full of stars. Cause you light up the park. I don't care, go on and tear me apart. I don't care if you do. Cause in the sky full of stars, I think I saw you. a sky full of stars. I wanna die in your arms. Cause you get lighter the more it gets dark. I'm gonna give you my heart. I don't care, go on and tear me apart. I don't care if you do. Cause in a sky full of stars, I think I see you. I think I see
We are stars, we are one. We light up the night like a black sun. We all shine, we are chrome, and we are shimmering. Turn on, turn on. Play it loud, we don't care. And dance like there's nobody there. Light up the night, yeah, light it up every night. Cause we are shimmering. Turn on, turn on. We are stars, we are one. We light up the night like a black sun. We all shine, we are chrome, and we are shimmering. Come on, y'all.
I was hoping for an indication. I was seeking higher elevation. I've been shaking, waking in the nightlight. I've been breaking, hiding from the spotlight. The more I stray, the less I fear, and the more I reach, the more I fade away. Darkness right in front of me, oh, it's calling out, and I won't walk away. I would always open up the door, always looking up for higher floors. Wanna see it all, give me more. I was always up for making changes, walking down the street, meeting strangers, flipping through my life, turning pages. Like a breath that only needs a reason, like a hunter waiting right in front of me, oh, it's calling out, and I won't walk away. I would always open up the door, always looking up for higher floors. Wanna see it all, give me more. I was always up for making changes, walking down the street, meeting strangers, flipping through my life, turning pages. I'm bursting like the 4th of July, so color me and blow me away. I'm broken in the prime of my life, so embrace it and leave me to stray. I would always open up the door, always looking up for higher floors. Wanna see it all, give me more. I was always up for making changes, walking down the street, meeting strangers, flipping through my life, turning pages. I would always open up the door, always looking up for higher floors. Wanna see it all, give me more. I was always up for making changes, walking down the street, meeting strangers, flipping through my life, turning pages. So that was a glimpse of activities at HR. I'm sure, sir, that would have made you nostalgic by seeing the videos and the college campus.
Oh, absolutely. Thanks a ton to the entire team. The video actually made me feel really nostalgic. I mean, it's been almost 11 years since I passed out, 2009 batch. Fortunately, I've always had the chance to be associated with the college in some way or the other, as a professor, now as a alumni, or in some form and shape. So really, thank you to you guys, for even giving me this opportunity to come and stay connected with students, and just on the eve of Teachers' Day. So that gives us something to celebrate as well. So thank you for this opportunity, and looking forward to the next half hour or so.
Sure.
Thank you.
I would now ask Professor Shweta Singh to introduce Mr. Bhargav.
Thanks, Saurav. It's an opportunity for me to introduce Mr. Bhargav Selarka. Mr. Bhargav Selarka is a senior professional working with global consultancy firm as a part of financial services, tax and regulatory services. Mr. Bhargav has a BAF degree from our own HR college. He passed out in the year 2009. He is also an associate member of Institute of Chartered Accountants of India. Mr. Bhargav has over 10 years of experience in advising and assisting international financial services companies, including private equity firm, banks, assets reconstruction companies, NBFCs, FPIs, etc., in establishing an Indian presence and doing businesses in India. Mr. Bhargav, area of expertise includes inbound and outbound structuring of investments, tax and regulatory advisory services, compliance and income tax litigation. So that was an introduction of Mr. Bhargav. Now I would request Mr. Bhargav to please take over and address the students. Most
Oh,
welcome, Mr.
absolutely.
Bhargav. Yeah.
Thank you, Shweta. Thanks
Uh,
for your kind words in the
uh,
introduction as well.
Bhargavji, just one thing. If you're sharing a PPT, there's one request to you
Right.
that please put the annotations off so that there is no disturbance on the PPT.
No, absolutely. I've done
Okay.
that. That's
Okay.
not a problem.
Thank you. Thank you.
Right. So I'm just going to share. So, sort of, you've given me the sharing rights, right? Sort of, I don't seem to have the sharing. Okay, I do now. Thank you. Is the screen visible?
Yes, sir.
Right. So, I'll obviously be checking in every 5-10 minutes probably to just check whether, the screen's visible or not. So just do keep me in the loop. Uh, you know, uh, at the outset, thank you to the entire team. And, I'm so glad to see such a good audience as well. And, all the learned students of the various, courses in HR. It's always, good to stay connected with the students because somewhere within our hearts we're all students ourselves yet, and we miss college as well a lot. I just hope that during these times everyone's staying safe and everyone's completely fine along with their families. And I this effort to hold this alumni series. I think it's a great initiative and a great task that the college has taken up. So kudos to the college as well. Uh, and thank you again for everyone's time and energy. I hope you find this useful. uh, Starting off, while I did speak to a couple of people as to what I should come and speak on, and I think you guys would have obviously a lot about equity markets, the bond markets, and several other markets that exist. But one extremely complicated market that we have in India, which has probably its pros as well as its cons, is our financial derivatives market. And this is something that is a very sensitive or a very tricky topic. And while I will just have to come and give you share some practical thoughts as well as talk about the basics, it's you guys who actually have to study it and probably appear for exams. I'm done with that. So good luck with that. Just be rest assured that's tricky, and you need to be really well and clear on the basics while approaching this topic. So I think that's just the preface to this topic. Every 1 or 2 slides, probably I'll just take a pause, and we'll try and keep it interactive. If you guys have any questions, you can probably use the chat room, post your questions, and happy to address them. And lastly, while the invite is a 4 to 5, I will try my level best, to honor that and finish it by 5 o'clock. Because as a student also, I'm completely aware of how long lectures can feel. So don't worry about that. Point is to keep it practical, to the point, and time bound as well. Uh, right. So just to start off, as I've mentioned, and I think as we've all known, what is a derivative? Uh, the way the people look at derivatives in today's world, be it bankers, be it professionals, or even be it students. Uh, a lot of the people look at it as something where you can make a lot of money or lose a lot of money. But in reality, that's a very speculative way of derivative is. Um, from a derivative standpoint, it has several uses in today's day and age. The uses could range from, yes, speculation being one of them, but also hedging and being an arbiter. So to that extent, derivative, when a person uses that term, it kind of just rings a bell as to something that is extreme or something that is, something to worry about. But in reality, one understands and applies a derivative in its finest and simplest sense. It can actually be something that make a financial system or an economy, uh, you know, go really up. And just to share a practical point, we've all heard about things like the subprime crisis. Obviously, you guys would have been extremely young when that happened in the year 2009, or something as recent, or probably even prior to that, was the Lehman Brothers crash. These are practical things that have happened globally. Uh, Let me tell you that these global events have all been a function or a trigger of derivatives. While I will share that practical insight with you, it's something that you guys should be well aware of as well. Now, in terms of what is a derivative, uh, you know, as the name suggests, to derive, right? To derive is something that really doesn't have an existence or value on its own. It's something that is really dependent on, or something that is a function of the value of something else. So a derivative, in its simplest and truest sense, is nothing but a contract that really derives its value from the underlying. The underlying could be, for example, a commodity, it could be a share, it could be a currency, or it could be anything that you want to put on. So a derivative, in its simplest sense, is something that really derives its value from something else, being the primary contract. Some key aspects of a derivative is that it's really a sum game. And what I mean practically when I say a zero sum game is that when we're trading in shares, or when we're kind of interacting in the financial markets, uh, if you're holding, let's say, shares of Reliance, and there are 10 others holding it with you, the price goes up, all of you are to really benefit. But in a zero sum game, what that term implies is that what is somebody else's loss. So in the end of a derivative contract, there has to be a winner and a loser. Now, unfortunately, if everybody could win out of a contract or out of the financial markets, it would be a great scenario. And if the demand and supply balances were effective, it would again be amazing for our economy as well as for the overall financial growth. But in a derivative contract, one thing is very clear: it's a zero sum game. Other part is that a derivative contract really is time bound, and something that is really bases a settlement. So let's take an example that I am bullish on a particular share price. Let's say there is a stock of Reliance Industries, and I feel that that share price today is 100, and I feel the share price is going to go to 140 in the future. So what I can do, and what the financial markets allow me to do, is that I can buy a right to buy the share at 100 rupees today on a future date. So that way, given that I am bullish on the stock and I believe that the stock price is going to go up, I will protect myself by buying a right to buy that stock today itself. So tomorrow when the price goes up, I can buy the stock at today's agreed price, and I can settle it on a future date by taking advantage of the price increase. Similarly, I could be bullish as well and think the price is going to fall. Now, in some derivative contracts, the settlement is mandatory. And what I mean by mandatory is that if I enter into a derivative contract with you, and at the date of a particular date, let's say a month down the line, you and me both have to honor the terms of that contract. Okay? That means it is obligatory on me as well as on the opposite party. In some cases, when it comes to settlement, it may not be obligatory, but it might be optional. So that is also another feature which we will discuss subsequently. But I think, this is the function of the way a derivative contract really works. A derivative by itself has absolutely no value. It is all a function of the underlying which it represents. Now, coming to a little more practical insight on the whole derivative product. Warren Buffett, we all know who Warren Buffett is, and obviously well known and finds place in a lot of your textbooks as well. He's unfortunately or fortunately termed what is derivatives as weapons of mass destruction. This is something that he had said, obviously in an unregulated and unsupervised market. So from that perspective, we need to be mindful that though tricky, they need to be handled well and they need to be regulated well. So, until the year 2000, the Indian regulated markets for derivatives did not exist. There used to be trading and there used to be different things that used to happen at any point of time. But since the year 2000, the Indian derivatives market is also well regulated. And trust me, practically speaking, I can vouch for it. The regulators see it and observe it and monitor it very closely. So I think what the learning from really this slide or from this page is that derivatives derive their value from the underlying, a lot of pros, a lot of cons, and we need to keep several factors in mind while dealing with derivatives. Moving to the next slide, right? Now, as I mentioned, in a derivative contract, there are multiple reasons why one would enter into derivatives. Okay, let's take for example, uh, I have a particular exposure in Reliance Industries, right? Just as a simple example. Now I might decide that, I want to really protect myself. So while I've bought the stock and I am bullish on the fact that it's going to go up, but at the same time, I want to protect myself against any potential risk that may arise. So I might simultaneously, while dealing in the actual cash equities market, I might also deal in the derivatives market. In such a situation, when I'm really taking advantage of a price or I'm really protecting myself against some sort of risk that I already have in a spot market or in a cash market or an equity market, I'm really a hedger. Okay. Really, a hedger is someone who is probably more conservative, more practical, and probably not that high risk. Probably a hedger could be someone who is called as risk averse. That is someone who is extremely mindful of his downside as well as his upside. On the other hand, if I decide that, okay, I don't hold a particular stock, but I believe the stock is going to go up, and I don't have the quantity or the cash to really pick up that stock in the cash equities or in volume, I will start taking bets on where the price is going to go, upward or downward. That is an extremely risky adventure, but those guys do exist in the market. And unfortunately or fortunately, there is no law really prohibiting something as speculation. So the people who really trade in the derivatives or deal in derivatives with having no underlying risk protection, they're precisely your speculators. Now, from a practical standpoint, when it comes to Indian residents, they could be a mixture of hedgers as well as speculators. And also at the same time, they could be people who do an arbitrage. Arbitrage is really what? Buying a particular position and also buying the opposite of that position, right? And trying to make a minimal profit or trying to make a minimal gain. So I think that is how the Indian residents really look at speculation, hedging, or even arbitrage for that matter. But these are three very fundamental and clear-cut terms that we need to keep in mind while dealing in or talking about the derivatives market. And these are terms you'll also see in the newspapers and the financial magazines or in all other forums, that really exist. The practical point here is that a non-resident that is there, right? We also have, and we've been reading in the papers in the last few months that, non-residents have been showing a lot of interest in the Indian financial markets. One thing that the Indian regulators have ensured to protect our economy as well as, to protect the financial markets is that not allow non-residents to enter into naked derivatives. Now, what the name suggests in terms of a naked derivative is basically a speculator. A speculator is someone who just deals in derivatives, taking a punt or taking a gamble or taking a bet on something that is going to increase or decrease, right? With having no underlying other investment or other transaction which he's trying to protect. So non-residents in that sense can't really do speculation. And that is something that has been very well protected by the Indian regulators. Yes, residents can. I'm not sure about how many of you people have heard, but we have this new concept, practically known as the International Financial Services Center, the IFSC. The IFSC is a center that's really located in India, but any trading done in that center is considered as good as being done outside India. It is basically a part which finds its place on the territories of India, but any activity done is considered as been done outside the territories of India. A new type of derivatives market on foreign exchange as well as on equity has been introduced in the International Financial Services Center, which is currently located in Gujarat. So I think this is on the derivatives, on what really a derivative is, as well as key terms that we need to keep in mind between derivatives as well as speculating and hedging. Before I move on to different types of derivatives, any questions, any thoughts from anyone? Sorry, I don't, okay, I see the chat. Right, so I see a couple of questions. I'll just take the couple of questions up, one by one. I think, there's the first question is, can you explain what hedge funds are? So really, what are hedge funds? Hedge funds are really, investment vehicles that are set up to precisely hedge particular risks and offer derivative products. That's something that hedge funds are. There are different types of hedge funds, be it index funds, be it gold funds, be it commodity funds. Basically, they trade in derivatives which derive their value from different underlyings. There's another other question which says, what do I exactly do in my job? I will, Mamta, I will explain that at the end of the call, I promise. So I think I'll just park that. Next is arbitrage profitable in derivatives market? So I think arbitrage is certainly profitable in a derivatives market. And, I think to answer that, we really are seeing how the Nifty as well as how the stock market is moving up and down volatilely, over the course of the days. One day you see it 400 points up, one day you see it 600 points down. So the more volatility that exists in the market, the higher chances of an arbitrage. So I think that's something that is really critical to understand from whether arbitrage is profitable or not. Now moving on to the different types of derivatives. In the subsequent slides, I have discussed futures and options in terms of strategies as well. But just to give you a brief on what the different types of derivatives are. Now, the derivative market is wide and enormous, but practically speaking, in the economy, 4 types of derivatives really exist: forwards, futures, options, and swap. Taking forward contracts once, okay, which is I think the fundamental forward thing that takes place currently. A forward contract really has no organized market. It is basically a contract between a buyer and a seller to say that I will sell you or I will deliver you a particular product on a particular date at a particular price. This is like an over-the-counter market. Take something as simple of, a simple example as there is a farmer in Punjab. During the months of April and May, he is harvesting his crop. Now, he's incurred, let's say, 100 rupees on harvesting his crop. The sale period might be November and December. Now, he doesn't know how the price is really going to go in the months of November and December. Okay, it might go up, it might go down, but today he's harvesting his crop. So he obviously wants to target to collect at least his input cost as well as some profit. So he will enter, let's say, into a forward contract with another gentleman and say that I will sell you my crop on a particular date at a particular price. So let's say he has an input cost of 100. He will say that I will agree to sell you this crop at 150 rupees in the future. And he sells it to him on that particular date at 150 rupees. that 150 rupees is the forward price, and what the farmer as well as the buyer have entered into is really a forward contract. A forward contract has absolutely no space today in a regulated stock market. It is primarily done over the counter, and it is between two parties. A forward contract can really be entered into in any shape and form, and it's not really a regulated contract per se. That is on the forward contract. Now coming to a future contract, I think what a future contract is something that is really different from a forward. A future contract is something that really allows you to trade in a particular underlying by being obligated to take delivery on a particular date. A futures contract is something that is regulated and it is done on the exchange. So what we see in today's day and time practically is that, let us say, for example, there is an individual who wants to buy a future, let's say corn, at 20 rupees a kg. There is someone who wants to sell that future as well. Now, what happens is, in that futures market, there is every day a mark to market that is done based on demand and supply. So let's say that 20 rupees becomes 20.5 based on the demand and supply. The person who wants to buy the futures contract has actually made a profit of 0.5, and the person who wants to sell it has made a loss of 0.5. A futures contract, in its simpliciter terms, is nothing but a contract entered into between two parties to deliver a particular commodity, share, stock, or currency at a predetermined price on a predetermined date, and it is something that has to be honored. It is not an option for the two parties to decide which way to go. If a futures contract is entered into, it has to be honored on that particular day at that particular price. So I think that is something that is fundamental to a futures contract. Also, a futures contract has several aspects associated with it in terms of margin money, in terms of the fact that it's regulated by the government as well as by the stock exchanges. And there's a lot of speculative activity that takes place in the futures market as well. So I think this is again something that we need to keep in mind as we move on. We will explain the future strategy in the next slide. But any questions on what we've done till now?
Bhargav, what about there's something currency derivatives? This called as,
Right.
Can you talk
Right.
about
So,
that also?
Sure, absolutely. So currency derivatives again are really okay. So your types of derivatives that we see today are your futures and options. Your currency derivatives are nothing but where the currency is the underlying. Okay. So what we may precisely see is that you have shares as the underlying, where you trade in a future or in an option contract, but where the currency is the underlying, it's really a currency there. So let me take an example that I am expecting today as a non-resident to receive $100, or let's say I'm expecting to receive 100 rupees. Now, the dollar and I am located in America. So I need to receive that money ultimately in America. So I will not receive INR, I will receive USD. So what I will do today, if I believe that the price is going to, really increase, because if it increases, I will surely get lesser dollars. So what I will do today is I will enter into a forward contract here at a particular price. So when that 100 rupees comes into me on a future date, I will use that currency rate only, which I've agreed with the bank by entering into a forward contract. And I will be able to purchase my USD at that pre-agreed rate. Even if this goes up or down, it really does not matter to me. So really, it is a contract which derives its value from the currency rather than any other underlying. So I think that is really your currency derivative.
Okay. And this sense is something called swaption also available. when you call option, there's something
Yeah,
called
so
option.
okay, so I'm coming to swaps and options as well, and
Okay.
I completely get that.
Okay.
So now coming to, so while we're clear on what is a forward and what is a future, coming to what is a swap, right? A swap is something that is, let's take a very simple example. And I won't give a theoretical answer to what is a swap. Let's say uh, I have a loan where I have to, let's say I am receiving a fixed rate of interest. Okay. Somebody else has a loan where they are receiving a floating rate of interest. And we all know what is a fixed and a floating, right? A fixed is where your rate of interest is fixed and fixated, whereas a floating really depends on your market conditions. It may be your London, your LIBOR, your IBOR, your MIBOR, whichever rates that you want to use as a benchmark index. And you kind of add a couple of basis points to that. So what I will do, particularly in a swap contract, is that the person who's receiving a floating rate of interest believes that no, the benchmark rate is going to fall. So my interest receipt I'm going to get is low. Whereas on the other hand, the person who's receiving a fixed rate of interest believes that no, the price is going to increase. So I wish I had gone for a floating rate of interest. So what these two gentlemen will do is they will exchange their receivables. The person who believes that the price or the benchmark index rate is going to fall, that means his interest income will be low, he will purchase the fixed interest rate so that he's securing his income. Whereas the person who feels that the interest rate is going to go up, okay, based on the benchmark, he will buy the floating rate. So that is really your interest rate swaps. And that is something that is fundamental that happens in today's day and age. Interest rate swaps are something that everybody in today's market has entered into and kind of undertakes as an exercise. So that is really your swap contract, where a person has a receivable, person has a payable, they kind of exchange it and they swap it amongst each other, and that becomes your swap contract. The most common types of swap contracts are your interest rate swaps, which are known as your IRS. Now, in today's volatile conditions, even non-residents have been permitted to enter into these interest rate swaps. So that's made the market more robust because more money has flown in and people are more bullish. And plus, for everybody's benefit, most of your interest rates are a function of your LIBOR, which is your London interbank rate, right? Whenever you're paying a floating rate, it is always LIBOR plus a particular amount of basis points. Today, as we speak, and as we're nearing December, LIBOR as a benchmark rate is going to be de-recognized because, as we all know, Brexit has happened, and the United Kingdom's out of the Eurozone. So as a function of that, the LIBOR is also being abolished. So that is going to have a major impact on the financial markets as well as on the financial management studies that we do on determining rates based on LIBOR. And certainly that will also have an impact on your swap contracts because people would have entered into swap contracts taking LIBOR as a base. But after it goes away, how bullish will the buyers and sellers be is something that will be, known only in the future. So I think that is your swap contracts. Coming to your option contracts, I think this is by far the simplest type of derivative. As I said, in a future, you are obligated. In an option, you have a right, but you don't have an obligation. So let me take an example of, in an option contract, there is always a buyer of an option and a seller of an option. A buyer of an option is always limiting his risk to the amount of premium. Whereas a seller of an option, okay, is always running a risk of unlimited loss, and his profit is limited only to the amount of premium. A person who sells an option contract is also a writer of an option. And as I said, a derivative is a zero-sum game. There has to be a winner, there has to be a loser. So option contracts are primarily two. There will be a call option and there'll be a put option. A call option is simple, but a right to buy. So basically, if I believe today that a stock having a price of 40 rupees today, the price is going to go up to 50 rupees in the future, That means I will be buying a call option. That is a right to buy the shares at 40 rupees today because I know it's going to go up to 50 rupees in the future. On the converse, if I believe that the price is going to go from 40 rupees to 30 rupees after 1 month, I will be buying a put option. That means I'm buying a right to sell the option at the price today of 40. So even if the price goes to 30, I will make a gain or I will make a profit because I have bought the right to sell it at 40 rupees. So option contracts are your call and your put options. When they say, we hear these terms a lot. I'm going long, and I'm going short. I'm bullish and I'm bearish. We hear these terms a lot in the newspapers, on the news channels. Going long means I am bullish on that stock. Long and bullish go hand in hand. That means I believe that the stock price is going to go up a particular level at a particular time. Whereas if I'm bearish and I'm going short, means I feel the price is going to fall in the near future. So long and bullish, short and bearish. I think that's something that we very often relate to in the newspapers as well as in the TV channels. I think these are your different types of derivatives. While swap, I did explain with the floating and fixed interest rate example, and forward contracts again, I did explain giving the example of the farmer. Futures and options do merit some discussion on strategies and when you should exercise it and when you should. And again, what I'm going to discuss is practical aspects. But before we move ahead, any questions or any?
Yes, Bhargavji, when you talk about derivatives, we also just have the strategies to be there. So there is something of butterfly strategy or something like that.
Exactly.
So
exactly.
how this strategy should be placed upon and what strategy to go into? Can you just also focus on that too and in the later part of it or wherever you are?
No. So Rahul, I've covered that in the subsequent.
Okay.
Now, unfortunately, there are given the markets, there are more than 100 strategies, but I've spoken about 3 to 4.
Okay.
That'll throw some light, and happy to even share some material on that for the benefit.
Okay.
But yeah, my slide is visible, right?
Yeah. Can you do a full screen of it so that we can take more pictures? Can you do full screen of it? Yeah. Thank you. Yeah. Proper.
All right. So now moving to a future strategy. Right? Let's take a simple example. I am on 31st December 2020. Okay, and obviously futures as well as options have a particular expiry date, and the expiry date is usually 1 month, 2 months, or 3 months. So let's say I have on 31st December, I have a futures price of INR 230, and that same stock in the cash equities market is trading at 220. The time period of the futures is 3 months, the time to expiry. Okay, that's 0.25 a year. My borrowing rate is 15% per annum. The dividend that one receives on this stock every year, let's assume for a second it's a fixed dividend which comes, is 25%, and the face value is 10. What I need to do in this situation, and this data that I have today will always be available to me as a trader, as a student, as an arbitrager, as a in any shape and form when you're dealing in the markets. And which strategy should you adopt? Which strategy should you not adopt? All that is really a function of what I'm just going to show you now. So this is some basic data always available in the stock markets as well as in general. Okay. What I need to do is that I need to at first determine a futures price on what it should be. Only then will I come to the conclusion on whether there is any arbitrage opportunity or not. If my futures price that I determine is somewhere in between my stock price and my futures price actually trading, then clearly the strategy should work. Now, how do I determine my future price as a strategist or as an investor? I have my spot price that's available. Now let's assume to buy that stock, I don't have owned funds and I have to actually use borrowed funds or leverage, correct? In that case, I will borrow 220 rupees at 15% per annum to purchase it. And obviously 15% per annum, so for 3 months, so 0.25. and I will be receiving dividend at the end of 31st March. So to some extent, my interest will be offset by the dividend receipt. Now, there is a very hyper-technical way of even doing a time value of the dividend, because if your interest due date and your dividend receipt date don't match, then there could be a time value issue as well. But having said that, I come to a futures price of 225.75. What this price indicates to me, the fact that it's between my spot price and my futures price in the market, is that there is an arbitrage opportunity. The minute I come to that conclusion, it is very clear that the arbitrage opportunity exists. Now, how will a person make money in this kind of a scenario or in this kind of a situation? Let's say he had bought the future, okay, at 230 rupees. That means he had said that I will do this transaction at 230. I will sell it at 230. What he received from the sale of that future is 230 rupees. In addition to that, he received a dividend of 2.50. Okay. Similarly, he had to repay the bank with the interest at 228.25. He happened to make a profit of 4.25 rupees. So it is in this simple terms that your future strategy really can work. Obviously, your profits may not be as high or may not be as low. Depends on your risk appetite, the capital, the volume, the fluctuations. But yes, the minute you come to the conclusion that you're between the futures price and stock price, you should really evolve a future strategy. That is on when do you go for a future strategy. Now coming to an option strategy, as I mentioned, you have your call options and you have your put options. You have a strike price of 40. You pay a premium whenever you buy an option to the person who's selling, to the writer, basically, of the option. Now, let us say on the exercise date, the price is 30 or the price is 50. If you have bought a call option, okay, means you have bought an option to buy at 40 rupees, correct? A call option is a right to buy. Now the price on the date of exercise has gone to 30. So obviously you will rather buy in the open market and not buy from the option writer. So all that you will lose is your 5 rupees premium that you have paid. Similarly, if in the spot market, the price has gone to 50 rupees, okay, in that case, you will obviously want to buy it at 40 because you have bought the right to buy it at 40, the right but not the obligation. So you will buy it at 40 and you will sell it at 50 in the stock in the spot market. But obviously your profit there will be only 5 because you've paid a premium also. That is when you've bought a call option. Similarly, in a put option situation, you've bought a right to sell at 40 rupees. Now let us take, for example, you have paid a premium of 5. The price on exercise has, let's say, gone to 30 rupees. So you exercise your right to sell at 40 rupees, correct? When the market price is 30. So you have a 10 rupee gain there, but you've paid a premium. So again, your profit will be 5. Similarly, you have bought a right to sell at 40. The price has gone to 50, correct? So you rather sell it in the spot market at 50, but your cost that you've incurred is of the premium. So your loss is 5. So this is precisely how your option strategies or your future strategies would really work. It's all a function of having base minimal data with you, basis which you can kind of run your option strategies. Now coming to, we've discussed how a future will work or how an option will work. Now coming to some peculiar strategies that people adopt. Okay. Now, there are butterfly strategies and reverse butterfly strategy and a lot of those terms. And there's a lot of literature available on that. But what I did is, while, in a limited time period, we can't discuss all the strategies, we've had 3 key strategies that we practically see people employ in today's stock markets. There is a strategy which is known extensively and employed by majority of the hedge funds, investment houses, is known as the merit put. Now, what the name suggests is that I purchase and buy a put option. Means I am simply, let's say, going and buying a stock of Infosys today in the cash market. I buy 100 shares of Infosys. Simultaneously, since I've bought 100 shares of Infosys at 100 rupees today, okay, let's say there is a put option available, there is a right to sell available at a strike price of 120. I want to ensure that I make that 20 rupees no matter where the price goes. So I automatically at the same time buy a right to sell at 120. I don't really take any sort of risk or any sort of major appetite out here because I'm holding the stock at 100 and I bought the right to sell it at 120. Means I'm kind of guaranteeing myself of some profit. While the merit put sounds, very simple and very lucrative and probably should work in all scenarios, the 120 example that I gave you is not existing in all stocks and all scripts. It's really a function of demand, function of supply, function of variable aspects. The risks are also extremely high in a merit put, because if there's major volatile movements, your entire strategy can go for a complete toss. But yes, the main strategy, while the butterfly strategy and all of that is there in theory, the main strategy that people in today's day and age, especially in today's market, which is so volatile, are exploring the merit put. The other strategy that is really there is your bull call spread or bull put spread. Here also, you buy calls and puts and you sell calls and puts simultaneously. So let's say I bought a call strike price of 100 rupees. Okay. I will then go and sell a call also at a strike price of 120 rupees. And when I say sell, be careful. I am saying I'm becoming a writer of an option. That means I'm making my losses unlimited. But my profit I'm limiting to the premium. So both ways, I am kind of doing a bull call spread or a bull put spread to really protect my premium no matter where the price goes. So in case everything goes awry and things don't go as planned, I ensure that to some extent I have protected my premium by doing a bull call spread or a bull put spread. This is also a very widely used strategy for people who really want to protect their premiums. Next, and the last one that we'll discuss generally, is your long straddle. It's basically an option strategy when an investor purchases a call and a put option on the same underlying asset with the same strike price and expiration date. Obviously, it's precisely, in a way, I would call this like, hedging your risks. I'm buying a call and a put. It will not always be a one-to-one hedge, because what you make on a call may be 100, but what you make on a put might be 80 or 90. So there'll always be an arbitrary difference. But yes, a long straddle is undertaking the same position on the same stock at the same price of having a call and a put option to take advantage of the minimal price differences. So in a way, I would call this more of an arbitrage strategy rather than hedging or speculative. Because you're kind of limiting your profit and limiting your loss because you're buying a call and a put option of the same underlying asset. So these are the three strategies that work day in and day out. And I would want to kind of put a very important fact here. These three strategies, the value of these three strategies today in the markets, in the global markets, be it US, be it Europe, be it Southeast Asia or India, the value of all these three strategies in today's markets is even higher than the amount of cash that exists globally in the banks. So you can just imagine the level of volume and the level of trading that happens in these three specific strategies. Besides this, there are multiple strategies that one can come up with. But as I said, you need to first do your simple basic calculations of whether a strategy is worth it or not, based on the examples we discussed earlier, and then come to a conclusion on which option strategy or which future strategy you really want to employ. But yes, in summary, these are the three key strategies. Now, just to conclude, and obviously we've run a little over short of time as well, but while the derivatives market we've spoken about in very, very brief, and we know it's a regulated market and it's something that really exists in a good shape and form. It's been criticized heavily on a global footing. And the reason it's been criticized, and as I said, Warren Buffett has called it, simply a weapon of mass destruction. And the reason why it has been criticized is because the largest economic downturns, be it 2004, be it 2007, or be it the 2009 crisis, was all on account of derivatives. Like for instance, your subprime crisis that occurred in 2009 in the US, which had a global impact, was nothing but derivatives. So what people were doing is that they were selling products with the underlying being loan portfolios or housing loan portfolios. So as people failed to pay up housing loans, the value of those derivatives fell. And the housing loan market was a boom at that point of time. That led to an entire subprime crisis. So people in today's day and age just bundle any product up, call it a derivative and start that trading. But unfortunately, it is the derivatives that have led to majority of the global economic downturns. A couple of key criticism points that even the RBI governor in his speeches has said, as well as which the RBI issues a bi-monthly report as well on derivatives, and we kind of deal with that and read that, and we prepare a lot of representation for the government as well, is that the government is incurring a lot of regulatory costs on regulating the derivative market. They feel it's very burdensome. And that's something that, they are very wary of, because the equity markets are far simpler, but the derivative markets are creating a lot of burden on the government, on regulation, household income, absence of savings, impact on, families, impact on wealth by virtue of speculation and all of that. Second is the displacement effect. And what I mean by displacement is that, our stock markets are famous. But as derivative market is evolving, people are moving out of the stock market and moving to the derivatives market. That is really not a good sign, because your stock market is really where there's liquidity. In derivatives, you can really buy and sell based on premium. You don't have to really make that investment besides your margin money. So this whole displacement effect also is kind of creating a lot of uproar, because people don't want them to leave cash equities, because that is where the storm is, and that is where really the liquidity gets created. So that displacement effect is also coming. Third is speculation and gambling. As I mentioned, the government has time and again reiterated that derivatives is for hedging and for arbitrage, but it's being used for a lot of speculative and gambling activities. So in fact, a recent report by the ex-RBI governor also said that even for residents, stop naked derivatives. Just allow them to do derivatives where they are hedging or they're doing an arbitrage, buying an opposite position at the same time. Unfortunately, the government can't impose that restriction because the derivatives are so well evolved now. But yeah, that's also one thing. And the last critical point is really instability in the financial system. As I mentioned, there's all the crises that have happened in the last probably 15 years have been a function of the derivatives market that existed. And derivatives would mean currency, shares, and even something as a subprime, where the derivatives was really housing loan portfolios. So I think that's precisely the criticism of the derivatives market as well, that has kind of just happened and taken place. So I think just keeping it short, simple, and long. I just hope that it was useful. Happy to. I don't see any questions on the chat. Happy to take any questions on, yeah, that's about it. Thank you.
Thanks a lot, sir. I definitely know that the students would have learned a lot from a session. It was really an insightful one. The way you presented derivatives and being such a difficult topic, you explained it really well. I just have few questions if you allow me to ask.
Yeah, please do. Go ahead, please.
Yeah, so as you said that the three strategies you spoke about are the most used ones and they are the most important ones. So is there any specific reason for the same that?
Yeah, no, I think the merit put is precisely so well prevalent is because I'm purchasing a stock and at the same time I'm buying a right to sell. So today I'm ensuring myself of a profit. I am not really taking a punt. Obviously, I may, by buying a put, I may decide not to exercise it also if the price goes very high. But at least to that extent, I'm ensuring myself of some differential when I've bought a stock. And I think that is why the merit put seems to be the most simplest and the most widely used strategy. Similarly, the bull call spread and bull put spread is widely used in terms of a lot of appetite. You're talking about billions of rupees involved in a bull call spread or a bull put spread. But in a long straddle, where I said you buy a call and a put simultaneously, it's like, for someone who's not having a large risk appetite and who's risk averse, doing a long straddle is just taking part of the minimum profit that he can make by buying a call and buying a put at the same time of the same price and same value. And he's in a way even limiting his loss to that nominal differential because he's really taking an opposite and equal position. Also, given the current financial situation, also on account, not only on account of COVID, but even before COVID, when the markets, because in my personal sense, the markets are overpriced to a very large extent. So given how overpriced the markets are and given how the markets have moved over the last 5 years, I think profit, even though minimal, people should be happy with. And hence these strategies kind of ensure that. Whereas other strategies are extremely risky, volatile. That's I think one of the key reasons, Saurav.
Thanks a lot, sir. And sir, one more question. So as we know that to have to gain experience in the cash market, we do have some simulation softwares and paper trading softwares. But do we have a software for derivatives market so that one could gain experience and then land onto the real trading? Because as you said,
Yes.
it's a sword, double-edged sword. It can make money and as well as it can lose money.
Sure. And you mean by software, you mean trading algorithms, or do you mean
Simulation softwares.
Yeah.
okay, simulation software? Yeah, there are plenty available. In fact, I personally operate a simulation. So I work very closely with foreign investors who have a lot of exposure in the Indian stock markets. So they have a lot of foreign exchange that is going out of India and coming into India on a daily basis. So we run a lot of foreign exchange simulations from them on the forex derivatives, on the currency derivatives. So there are softwares available, and in fact, a lot of today's startups are focusing on derivative softwares because equity is available in plenty in terms of algorithms as well.
I think Devik had a question. Devik?
Yes, ma'am. Hi, sir. This is Devik here, sir. So, sir, as you said, sorry. Okay. So, sir, as you said in the seminar that in a derivatives market, we should always hedge our positions. And as you just mentioned that Warren Buffett said that derivative market is a weapon of mass destruction. Then is there anything or any market that can hedge the derivative market itself? So that was my
Hedge the derivative market itself, meaning, sorry, could you explain that a little?
Okay, so sir, as you said that in a derivative market, we should hedge our positions, hedge our risks. And Warren Buffett said that derivative market is itself a big risk. So is there any market or is there any such thing that can hedge the derivative market? The whole derivative market?
I think the minute we create that kind of a market, I think all of us will be billionaires. So I personally, not that I've heard of, but people are coming out with a lot of different strategies, different products. So whether hedging even a derivative position is possible within derivatives itself, but is there a market that exists? I personally not sure or not aware of.
So do you think the cryptocurrency market can be a hedging position for a derivative market?
A cryptocurrency market, okay, unfortunately, those contracts are void.
Sorry, sir?
Unfortunately, in India, the contracts are void for cryptocurrencies as the law stands today. But if they do allow the cryptocurrencies to even become probably legally valid tender, then in that case, yeah, from a currency derivative perspective, cryptocurrency surely will hedge that. But you'll have to evolve that correlation. And the economy will have to accept it as an accepted mode of legal tender, which is not the case today in India.
Right. Okay. Thank you, sir.
Sir, I had a doubt.
Yeah, sure.
Sir, recently I was watching this movie, The Big Short, where the hedge fund manager created these swaps by buying against the whole American economy, like the debt market, like AAA bonds and something. So how can...
Call.
Yes, sir. So what was that? I didn't understood that. So
no, so that was exactly that. So I'll tell you what that was we all know, and I spoke about the subprime crisis, right? So what happened is back in 2009, uh, the real estate industry in the US had taken a big boom. So a lot of people had taken real estate loans and from banks, and banks were receiving interest and principal. And the houses they bought were secured against those loans. Now, what happened is that given the large amount of loans that were given, JP Morgan, Deutsche Bank, they all thought that the right thing to do is let us issue a derivative product having the underlying of these loan portfolios. So if the loan portfolios receive interest and principal on a regular basis and they are honored properly, and if the value of the real estate goes up, let's say it's not valued or the person fails to make the payment, and the real estate value goes up, they will buy the property, sell it, and make money. Now, unfortunately, what happened is that people in America lost jobs. They failed to make payments of loans, and simultaneously, the prices of real estate also fell. So, all the derivative products that were issued with the loan portfolio for the housing loans being the underlying became kind of zero value. So, what one hedge fund did in the US is that he met a lot of people and he identified this bubble. So before he got 10 cents to every dollar, the day before the subprime crisis came out, he went and sold each dollar for 85 cents. He said, I'm willing to take a 15-cent hit, take it for 85 cents. But the real value of that was 10 cents, given that he had foresight of what is going to happen the next day or subsequently after that. So that was really the position that he took in that. I can't say that movie is a true story. So there is only one hedge fund that really ended up making billions of dollars in spite of everybody losing it.
So after that, we can buy that swaps. Like everyone was ready to buy that swaps, so we can trade on swaps also.
Yeah, so everyone was ready to buy it because they were not aware of what is going to happen the next day.
Okay, sir. Thank you.
But the whole value of that derivative fell because the underlying had no value. So as I said, a derivative is a function of the underlying. A derivative on its own has zero value.
Okay, sir. Thank you.
Yep, no problem.
Okay, Bhargav, I have a question popping up on the chat box. Can you please explain the credit default swaps?
Sure. So again, credit default swaps are again your CDS is again something related to what we just discussed on your prime sub. It's like taking a punt on your loan portfolios, on your interest liabilities, on the ability of a person to pay back something. You are taking a gamble on that, and the minute that goes wrong, your derivative falls. So your credit default swaps are nothing but that. It's very simple. It's like the government telling banks that I will make good this money to you at some point of time. So yeah, your credit default swaps are in a way taking a punt on ability of people to repay.
True.
And being your underlying.
Okay, one student wants to know if we want to know about futures and options and all the strategies in a simpler language. Is there any book that they can refer to, or any?
I will share that. I will share the relevant book, the link of the book.
Okay. Okay.
Yeah, I'll share it with Shweta. In fact, I have a lot of material myself, but yeah, the latest publication I will share, and just feel free, Poonam, to share my number as well with that person. Happy to always talk to that person and have an intellectual.
That would be really great. That would be really
Absolutely.
great.
Always.
Okay. The next question is somebody wants to know about the new SEBI rules.
On
the,
Yeah,
The margin ones, yes, sir. It's like
pretty confusing.
No. So the new SEBI rules on the margins are really for the brokers, not really impacting the investors much. But what happens is that the brokers also act as clearing members, because every deal that you execute has to go through or has to be undertaken through a trading member. So all that SEBI has said is that given the volatility in the market, increase the amount of margin. In simplicity terms, that is all that SEBI has said. But that's created a lot of discomfort amongst the brokers, the SEBI registered brokers, given the lack of liquidity. So in simplicity terms, that's precisely all that is. There have been a lot of newspaper articles on lobbying and issues and all of that. I think just look through that. SEBI's simply gone ahead and said, look, boss, I need this amount of money from you to continue to trade in the markets, in the derivatives market or in the forwards market. And that's where it ends. So you can ignore all the newspaper articles. SEBI's not changing their mind.
So wouldn't it push down the economy?
It will in the short term, yes, but in the long term, no. Because as I said, derivatives are speculators. So the minute they increase the margins, they're cutting out the speculators. And we don't need speculators.
Okay, Bhargav, next question I am asking on behalf of the students. Now, the derivative market looks very fancy, but as a recent graduate, like one who just cleared BFM, what is the ideal way to know is this my cup of tea or not? Because I know it's a high pressure ball game. So,
So, uh, honestly, like on my personal view to anybody who's just graduating, do not trade. Depends on what you are. If you're seeking a job, if you're seeking, uh, part-time savings and investments. Again, my personal view that I'm sharing, and it's all subject to facts and situations, is that take an exposure in markets through mutual funds and be very simple and straightforward. Derivatives is something. If today, let's say you open a business of trading in gold, or you open a business in manufacturing of corn, or manufacturing of vehicles and chairs. Now, if there is a forward contract available for that, then you might do it. But I'm saying it really depends on the kind of business you have. But if you're looking at just simply getting into a job, undertaking it, I think doing naked derivatives, uh, I have tried it and not done so well. So I would, based on personal experience, say that it's not something I would recommend immediately after graduating, for sure.
okay, the next one is, do you think Merit put works effectively on Bank Nifty as it considers higher fluctuation on daily basis from both ends?
Merit put works effectively only on Bank Nifty, given the large volatility that exists. And Bank Nifty, or why even your Bank Nifty, your General Nifty also it works on equally effectively.
Okay. Bhargav, how long are you going to answer the Q&A? Because I can keep asking questions.
No, I actually unfortunately have a hard stop at 5:25, 5:30. I have another commitment at 5:30.
Yeah, there are a lot of questions in the chat box.
Yeah.
So we can mail him all the queries, and he can answer it separate.
Please. No, I'm happy to do that. Yeah, I will also learn. So please email me all the questions. Happy to take them on.
Sure.
Yeah, absolutely.
And Bhargav, I think the students would like to connect with you on LinkedIn. So if you can share your profile and they can connect with you.
Yeah, absolutely. I will share my link. So I think I'm in touch with Sweta. I'll share all my details. And just a shout out to everybody. It's not just on derivatives. To give you a profile for 2 minutes, I work with Ernst & Young. I've been in this profession for more than 10 years now. I'm a director there, and obviously looking at the tax and regulatory practice very closely. Do reach out to me for any sort of job advice, guidance, support that you guys need as well. I'm sure you have your HR college who's going to take care of that completely. They did that for me. So I'm pretty sure they will do that for their future batches as well. But you have my number, just ping me and just reach out to me. And for those who are not aware, or I don't know if you guys are aware, but I've been teaching for 5 years.
Oh.
SYBAF business law. So
Wow.
I go back a lot. I go way back with Hina ma'am and Meena ma'am and Indu ma'am, way back. So I've been associated with that for a lot, and even with the recruitment team. We've picked up a lot of people from BAF and BBI. So, just stay connected, and always happy to help and at your service.
So Bhargav, are you coming in for teaching again?
Yeah, absolutely.
Later, some old memories.
Yeah, so corporate law, yes. I mean, that's something that I've obviously always been doing. But yeah, BFM is something I've not really had my hands at yet. But yeah, in the near future, why not?
Very soon we will call you for that as well.
So definitely now we are going to connect
not just lectures, Bhargav sir, but also about we're looking at proper workshop kind of thing also. We're looking also with the HSNC University, also looking at more practical courses and certificate courses or diploma courses where people like you can help us out to draft the entire syllabus, which is completely market oriented, and they can go out and stand out in the entire job market.
No, absolutely. And while we focus a lot on derivatives and financial markets and accounting and tax and all of that, I think a key point for graduates is soft skills.
True.
So aspects on personal branding, how to
True.
job interview, how to kind of search a job, how to discuss, how to identify your own pros and cons. So I do a lot of these sessions at EY as well as with the Western India Regional Council. of the chartered accountancy. So, happy to even put you in touch with some people if that helps.
Oh, that will be really great.
Wonderful,
That will be really
wonderful.
great. That will be really
Yeah,
great.
but just my suggestion: be focused on the soft skills as well.
True.
The technical parts are something people will learn as time passes, but soft
Yeah.
skills are paramount.
True. Agreed, sir.
Yeah.
So with this, I think we have answered all the queries. Have given all the ways to reach out to you, and I feel this will really go on the long run and help all the participants who are there with us on the Zoom platform, and also who are there watching us live on YouTube and will watch this thing
Right.
later on also. So thank
Right.
you so much on behalf of HR College
Absolutely.
and all the coordinators present here and all the students present here and the HSNC University and the HSNC board. I once again extend my thanks to you, my gratitude for
Absolutely.
coming out, sparing
No,
your
no.
time,
No, absolutely.
and specifically focus on minute things also. You said about the most important said, focus on soft skills. So because as and when things progress, you also learn on the job also. So that is another part. But yes, one should also focus in the during this particular course of their graduation, focus more on developing and branding yourself too. So thank you so
Absolutely.
much. Thank you so much once
My
again
pleasure.
on
My
behalf of
pleasure.
HR and all the coordinators and teachers, students here. And
Absolutely.
I'm looking forward to have you more after the pandemic. Unfortunately, during pandemic
Yes,
we are
absolutely.
on the new normal way, but after pandemic definitely we'll have you in our classrooms taking mentoring and guiding students
Absolutely.
and even
Absolutely.
us also. Okay,
Always available.
thank you
Thanks a lot.
so much, thank
Thank
you
you,
so
guys.
much, thank you
Cheers.
Thank
everyone
you,
for
Bhargav.
joining
Thank
in.
you so much for coming in.
Thank
you.
you,
Thank you so
sir.
much, sir.
Thank you,
Thank
sir.
you. Ma'am, you can formally end the meeting now. And live on YouTube also, that should be ended. Devik, take care of that.
Yes, sir.
You can end the meeting now.